What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis, and today we're going to talk about a topic that comes up quite often. Can I write off my car? So if you're a real estate investor, flipper, small business owner, your vehicle is one of your larger recurring costs. You have gas, insurance, repairs, car payments. It can really add up. The tax code here gives us a few options to turn that into a deduction, but as usual, anything with the IRS is going to come with certain rules that you need to follow. So today we're going to cover the main ways to deduct your vehicle, how the depreciation works, how Section 179 and bonus depreciation work, and then any rules and traps that come with deducting your vehicle. Quick disclaimer before we dive in, this is educational, not personalized tax advice. As always, check with your own tax pro about your specific situation, especially with all the recent changes to the tax law with the One Big Beautiful Bill. Let's take a look and see how this works. So first, your vehicle is not simply deductible because it exists. You have to have business use to get a deduction. That seems like common sense. So the IRS looks at this as business versus personal use. So let's say you use your car 70% for business, 30% for personal. At most, 70% of the eligible costs will be deductible. There's really two important rules to touch on up front. One is commuting is not business mileage. So driving from your home to a regular office or to a job site, that's considered commuting. It's that first part of the trip of the day and then coming home at night. The IRS says no deduction allowed. But to contrast that, if you're driving from one business location to another business location or job site to job site, then that's another story. Those are business miles. And if you're driving from, say, you have to make a special trip to the store, maybe you have to go to Staples to get some office supplies, that would be business mileage as well. You're taking a trip for a specific business purpose. So no commuting miles, and you have to have a mileage log of some kind to record your mileage and prove it. If you're ever audited, the question is not, did you drive for business? The question is, how are you going to prove to us how much of your driving was business versus personal? So you use apps, there's apps out there like MileIQ, spreadsheets, a paper log, any of it's fine, but you can't just say, I think I drove about 80% for business with no backup. That will get the entire auto deduction thrown out. So let's just say, for example, you're a real estate agent and you have different types of mileage, driving to showings, listings, closings, inspections, those sorts of things. That's all business mileage. Driving from home to your regular office every morning, that is a commute, so not business mileage. Or driving from your home to Staples to pick up office supplies. Now we're talking business mileage. So once we know your business versus personal use percentages, then we pick up how we're going to deduct it. And there's two options. You have the standard mileage rate or the actual expense method. So the standard mileage rate, the IRS basically says, look, instead of tracking every gas receipt and oil change, just track your business miles and multiply that by the rate we give each year. That number is your deduction. So for 2025 taxes, the IRS business mileage rate is 70 cents per mile. That's what you use for your 25 tax return. This would say if you drove 10,000 business miles in 2025, you'd have 10,000 times 70 cents. It's a $7,000 deduction. Now, I'm recording this in December 2025. We don't have the 2026 rate yet, but it's expected to go up probably somewhere around 72, 73 cents. We'll just have to see. So the rate's designed to approximate things like gas, maintenance, and depreciation. So you can still deduct some out-of-pocket costs in addition, but that's limited to things like parking and tolls that are related to business. So those are in addition to your standard mileage. But the pro side of using the standard mileage rate is it's simple to track. If you drive a lot, high miles in a low or moderately cost vehicle, that the standard mileage rate is going to work better for you over the life of the vehicle. So that's probably what you're going to want to look at. You don't have to track every little car expense in addition to your mileage either. But then the downside is if you own an expensive vehicle and with high maintenance insurance costs, then the actual method might give you a better deduction, but so then you're kind of tasked with tracking those expenses on top of the miles. You still have to track miles in both cases. So if you want the option to use standard mileage for your vehicle, at some point, you generally have to start in the first year it's placed in service. So once you start with actual expenses on a specific vehicle, you can't flip back to standard mileage for that same car later. If you start with standard, you can actually change over to the actual method later on. So now let's talk a bit about the actual method. Under this, you add up all the costs of owning and operating your vehicle. So gas, repairs and maintenance, insurance, tires, oil changes, lease payments. If you're leasing, if you own it, you get depreciation. We're going to talk more about that in a minute. Property taxes, registration, all of those costs. Then you multiply that by your business use percentage. So let's say your total costs for the vehicle for the year are $10,000. You use it 70% for business. You're going to end up with a $7,000 auto deduction. Now let's touch on depreciation. So depreciation is really just that the IRS saying, hey, you bought an asset the last several years, you get to deduct it over time. So for most passenger vehicles, the default depreciation schedule is 5 years. But there's special limits. They're usually referred to as the luxury auto limits. So the IRS sets caps on how much depreciation you can take each year on passenger vehicles for business. So for vehicles placed in service during 2025, that first year depreciation limit with bonus depreciation is $20,000, $200. And if you don't use bonus, it's $12,200. So those limits are expected to change a bit in future years. If you buy, say, a $60,000 luxury SUV that's under 6,000 pounds, so the IRS kind of has different categories of vehicles based on weight. So under 6,000 pounds, you're going to be using, and let's say you're using actual expenses, you don't just write off the $60,000 car, you're capped to those luxury auto limits, and you still have to multiply by your business use percentage. So again, it's assuming 70% business use with the first year limit with bonus depreciation being $20,200, you take your 70% business use times $20,200 and you get a $14,140 maximum depreciation and deduction for that vehicle. That doesn't include all the operating costs, it's just the depreciation component. So now let's talk about Section 179, and it can also be used in combination with bonus, which can help increase your write-offs for heavier vehicles. So these rules change with the One Big Beautiful Bill. The auto deduction limits are actually lower for a lot of people than they were in prior years, especially for those vehicles that are over 6,000 pounds. So with Section 179, you can elect to expense the costs of certain business assets the year you place them into service. So businesses can generally expense up to $2.5 million of property using Section 179. And then if their total asset purchases exceed $4 million, that starts to phase out. But most small businesses aren't going to run into that phase out. So there are vehicles with special limits. So heavy SUVs, those over 6,000 pounds. But not over 14,000. So they're in between 6,000 and 14,000 pounds. There's still a cap on how much you can expense under Section 179 in the first year. For 2025, that cap's going to be around 31,300. For 2025, last year, if you bought a truck over 6,000 pounds, say it's a pickup truck for your construction business, you could deduct the whole thing year one. The only limitation would be the business use. So if you used it 80% for business, you could deduct 80%. That was if it was over 6,000 pounds. Now, Section 179 is going to be limited to a bit over 31,000. Now, heavier trucks and vans that aren't designed for passenger use can sometimes escape the SUV caps, but these are like specialized vehicles, buses, larger things that they aren't designed for passengers, not your traditional pickup truck. There are some cases that escape that SUV cap, but that's not going to be as many and as often as before. It used to be pretty easy to get around that. It was just the vehicle weight. Now the rules have changed. Now to use Section 179 or bonus depreciation for that matter, the vehicle has to be used at least 50% for the business. If not, there's no Section 179, no bonus allowed. It's just the straight 5-year property based on your business use. Now, your Section 179 deduction is also limited by taxable income for the business. So you generally can't deduct any more than you have business income. You can take your income down to zero, but you're not going to generate a loss. Now, bonus depreciation, on the other hand, bonus does allow you to generate a loss. And as we recall, it was phasing down over the years, starting in 2022, but with the one big beautiful bill, now we have 100% bonus back for any assets that were acquired on or in place in service on or after January 20th, 2025. So for many business vehicles that qualify, if you place them in service in 2025 after that January date, now you get the 100% bonus depreciation, but you're still subject to that cap, that $20,200 for bonus depreciation we talked about earlier. But however, you can use Section 179 and bonus. So there's still luxury auto limits on regular passenger vehicles that are under 6,000 pounds, even with bonus depreciation. So bonus doesn't let you, write off a $90,000 Range Rover. It's still technically a passenger vehicle. And then the heavier vehicles, 6,000 pounds and or over, that are used more than 50% for business, you get the combination Section 179 plus bonus that can get you close to a full write-off. So that 6,000 pounds limit is still a cutoff test that's going to allow you. In the past, Section 179 could have deducted the entire cost, but now you're limited to with Section 179, a little over 31,000. But then on top of that, you could put bonus. So you can take the Section 179, then apply bonus depreciation on these heavier vehicles to the remaining cost, and you get to kind of tack those onto one another. So a stacking strategy. And then if there's anything left over after the Section 179 in bonus depreciation limits, that's going to be depreciated as normal over 5 years. So now let's put together all the rules. Like, what does the IRS care about? So we've mentioned the business use being more than 50% for the big stuff. To use Section 179 and bonus depreciation in the way we were talking about, that vehicle has to be used more than 50% used for business. If you drop below 50%, business use in a future year, you'll actually have recapture to deal with, meaning the IRS is going to add some of that deduction back as income if your business use drops below 50% and you've used Section 179 or bonus depreciation on that vehicle in the past. You also need good records, mileage, dates, the purpose of your trips. So for each vehicle, IRS wants to see substantiation, total miles driven for the year, then that broken down by business miles and personal miles. Good thing to have is starting and ending odometer readings for the year. For business trips, you want to have the date, the destination of where you're going, and the business purpose. Now, mileage apps make this a lot easier. Something like Mile IQ, you have it on while you drive, and you could swipe business or personal for each trip. The vehicle needs to be placed in service to claim depreciation, bonus, or Section 179, or the standard 5-year makers. In any given year, the vehicle has to be placed in service that year, meaning it's already being used in the business, not just ordered or sitting in the dealer's pipeline. Maybe you've paid or signed a contract in December, but you don't get the car and start using it until January, then that's a next year deduction. Let's look at a couple quick examples. So let's say we have a real estate agent that's using just a standard sedan car. They drive 18,000 miles in 2025 for business, 18,000 business miles. But they had a total mileage for the year of 24,000. So we're looking at 75% business use, 18,000 divided by 24. This is a regular car under 6,000 pounds, modest operating costs. The two options we have are standard mileage. So you take 18,000 miles times 70 cents per mile and end up with a deduction of 12,600. If there's any tolls or parking, you can deduct those costs in addition. If you want actual expenses, let's say total costs for this vehicle, the depreciation, insurance, gas, repairs for the year, total 13,000. Well, the business use of 75%, that gives us a deduction of 9,750. So in this case, standard mileage rate is going to be a greater deduction by almost $3,000. A simplified example, and in this case, standard mileage wins, but it's way easier to track just to keep the mileage log. Pretty common for people that put a lot of miles on their car to be in this position. Let's say example to let's say you're a contractor that buys a heavier truck, like a heavy duty pickup. And in 2025, you pay $80,000 for this. The vehicle's, the weight's $7,500. So you're over that $6,000 limit. And in this case, the business use is 90% measured by the mileage log. So it was put in service in, let's say, October 2025. So after our January date for 100% bonus. Now what we can do with this vehicle is take Section 179 up to the limit, a little over 31,000. And then bonus depreciation, use 100% bonus on the remaining 90% business use cost. So we're looking at a first year deduction that could be somewhere in the neighborhood of 90% times 80,000, $72,000. There's going to be subject to the mix of 179 and bonus and the vehicle classification, but it's possible to get up there with those heavier vehicles when you combine Section 179 and bonus. There'll probably be a bit left over for makers, but that's a huge deduction now. Just remember, it means lower or no depreciation in the future. And you may still be making payments on the vehicle, which means that's cash going out the door with no related deduction. So just something to consider. If your business use falls under 50%, again, that you can end up with a recapture. But with these heavier trucks, there's greater limits when you combine Section 179 plus bonus depreciation. So let's do a quick, just few questions, talk about a few myths. So I hear this one a lot. I wrap my car in my business logo. That makes the whole thing deductible now, right? And that's not true. So the wrap itself is a marketing expense, sure. The vehicle is still subject to business use percentage and all the normal rules. Another one I hear a lot is I bought a luxury SUV for my real estate business. Can I just write this whole thing off? Now in 2025 and in future, if it's under 6,000 pounds in 2025 or even before, then you have the auto limits that apply. You can't just expense the whole thing in year one. If it's over 6,000 pounds, you used to be able to use Section 179 on certain vehicles over 6,000 pounds if they were used more than 50% in the business. However, now Section 179 does have a cap, but if they're over 6,000, you can use Section 179 and bonus together, which might allow you to write off a huge chunk of that, but still going to be limited to the business use portion. So you have to, whatever you calculate your maximum depreciation deduction is, times that by the business use percentage, there's your deduction. What if you don't track miles? Just estimate, ballpark it. So in an audit, that's almost always going to be a problem. The IRS expects contemporaneous records for things like vehicles because they know most people that own vehicles, they're using it personally in some way. So mileage logs created near the time of the trip are considered contemporaneous, not a guess at year end. Another question I hear a lot is the LLC owns the vehicle, then that just makes it deductible, right? That is also false. So ownership does not replace business use. Doesn't matter if you own it personally and use it in your business or if the business owns it. If to take a deduction, you're going to have to show how many business miles there are, how many personal miles, and that's going to decide the deduction. If it's a company-owned car and it's used personally, that can create some taxable fringe benefits. Sometimes you'll have an amount added back to your W-2 to account for that personal use portion. But just putting the vehicle in the name of the business, sometimes it technically belongs in the name of the business. You still only deduct the portion that is business use. So to recap here, there's two main ways to deduct a vehicle. We have the standard mileage, simple and great for high miles with modest car costs, or you have the actual expense method, more work, but necessary if you want to use certain larger deductions and Section 179 and bonus depreciation. You have to use the actual expense method. Better for more expensive vehicles. Depreciation spreads the vehicle costs out over time. Passenger cars under 6,000 pounds, subject to those luxury auto caps. Heavy vehicles over 6,000 have more generous rules, but you still need more than 50% business use and you need to be able to prove that business use. So that about does it for today. I hope you found this helpful. If so, please share it with another business owner or investor. Until next time, have a great day.
Are you interested in becoming a client? Click the Discovery Meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.